This video is not about random meme coins, about hopium, about 100x returns with small money. This video is about serious investing. Because here's the thing, over our lifetime we tend to save more and more money, and thus our wealth relative to our income grows over time. At the beginning we might just have a few weeks of income in wealth, then a few months, then a few years, and once we are at say 5 or 10 years of income all saved up, then it's very, very important not to just have this all in cash. And then the question really becomes, what are opportunity costs of an investment? Because holding the money in cash is not really an option, maybe just for a small fraction of the wealth. But when we've got years and years of income saved up, we can't really afford to have too much money that goes away via inflation. And so one of those options is obviously Bitcoin, right? This is the Bitcoin strategy channel, and we can nicely see how at the beginning Bitcoin grew very, very quickly on this logarithmic chart, and now the returns tend to somewhat diminish. In the last years, Bitcoin didn't grow that much, relatively speaking, anymore compared to the early years. Now, there are different parts in a portfolio, right? There's the risk off stuff, for example, the property that's 100% paid off, or maybe the precious metals. And then there is the risk on stuff, right? For example, Bitcoin or technology stocks. And so the main target should always be to achieve as much return as possible with as little risk as possible. Now, one way to reduce the risk is to buy assets that have very little correlation to one another. So when we buy asset A, we don't want that asset B at the same time moves in the same direction. In other words, when say Bitcoin goes up, then we don't want that the other asset goes up as well, or especially when the things go down, that we don't see everything crashing at the same time. And so the magic word is of course diversification, and the effect of diversification, so the gain that we get in risk reduction, is the bigger the lower the correlation is. In other words, if we have two investment opportunities where we're considering should we buy A or B, and we tend to see very high correlation, in other words, the assets move in the same direction at the same time, then we really have opportunity costs. Then we really have to consider should we buy either A or B. We shouldn't necessarily own both because we can't get any diversification benefit from owning both, right? We should decide either A or B. And so let's get back to Bitcoin. Because in the first years of Bitcoin's existence, we had a lot of idiosyncratic movements. So Bitcoin went up and down with very specific movements that were not correlated to anything else. For example, this down movement over here was due to Mt. Gox and due to Silk Road shutting down. That's an event that was Bitcoin only. During the time, other assets tended to rather appreciate. Now have a look at this chart. This is the Nasdaq 100. So this shows how are technology stocks doing. And this vertical line over here is when Bitcoin got introduced. And this squiggly line here at the bottom, that's the correlation coefficient of technology stocks with Bitcoin. When the correlation coefficient is at 1, that means that the two assets tend to move in the same direction at the same time. When it's at -1, it means they move in opposite directions at the same time. In other words, for a diversified portfolio, we want to be as much as possible close to -1, and we want to be as far away as possible from +1. Unfortunately, over the last 3 years, Bitcoin and the Nasdaq 100 tended to move more and more in sync with one another. The correlation coefficient is comparatively high. The times of -0.8 or -0.6 are now over. Bitcoin is getting adopted by Wall Street, by traditional finance, as another risk-on asset. And when the market as a whole crashes, like let's say traditional finance is going down, for example, during the COVID crash, then Bitcoin will go down as well. There is now more and more correlation. And that makes me believe that in case we see a real crisis again, similar to what we have seen with the Nasdaq during the .com correction, or say during the global financial crisis, that likely we will see a similar correction then also in Bitcoin. But during Bitcoin's existence, we've never really seen a strong correction, right? We've seen a little bit of a down movement in 2022, and we've had our little COVID crash, but it's not comparable to the global financial crisis or to .com. And so let's go back to our portfolio. We've got parts that are risk on, we've got parts that are risk off. We've got gold and property, but we've also got potentially Bitcoin. And here's the point, or technology stocks, not necessarily Bitcoin and technology stocks anymore, because again, the correlation is going up. The question is, what's the better investment now? Now, I'm not saying we have to be completely pedantic about this, right? To not own any QQQ whatsoever, but there should be a strong bias towards one of the asset classes, again, because the correlation is very high. And so then a chart like this is useful. This is Bitcoin relative to the Nasdaq 100. How much did Bitcoin outperform the Nasdaq 100? Because Bitcoin is more volatile, we take on more risk by buying Bitcoin. How much did we actually improve in terms of performance? Did we actually get a better risk to reward? And of course, in the early years, the answer is yes, right? Bitcoin outperformed the Nasdaq 100 quite substantially. But since the end of 2017, the outperformance isn't really that large anymore. There is still outperformance, but it has been 48% roughly over the course of 7 years. If you bought Bitcoin when Bitcoin was at 20K rather than the Nasdaq 100 at this top, you would have a bit under 50% more money compared to just allocating towards tech stocks, compared to just buying QQQ. And that outperformance comes at the expense of temporarily falling 84% over here or 72% over here, right? That's the additional risk on top of just holding tech stocks. So there is outperformance, but there's also way more risk. Now, it's no surprise that the outperformance is also declining over time. And the question is really, by how much is it declining over time? Are we still going to see a lot of long-term outperformance? Because let's just connect those tops with a random curved line. But interestingly enough, those tops align quite well with one another. There seems to be some kind of a support, but there also seems to be some kind of a resistance. Those lines will meet at some point, and this will break out in either direction. Either we go down again versus tech stocks, maybe by 70%, or we see the final breakout. It's not super straightforward to answer what is going to happen, because from my perspective, both asset classes or both assets are very much overvalued now. For example, this is the Nasdaq 100 relative to the S&P 500. So what is the value of technology stocks relative to all other stocks? This chart starts in 1985, and this correction that we see over here is the dot-com burst. So that's when technology stocks underperformed the rest of the market by roughly 70%. Outside of those exaggerations and subsequent implosions, we see what we expect to see, right? We see that the additional risk that we take on by buying tech does get compensated. In other words, growth stocks really tend to grow more over the long term. But again, the question is, how long will this continue, right? Will all the promises with AI, for example, materialize themselves into real economic gains? So far, we mainly see how companies are investing into AI, how all those GPUs are bought by NVIDIA. But we don't really know 100% yet if those companies that bought all the GPUs are actually going to make long-term profit with them. Will artificial intelligence applications turn into real economic value, and how fast will it happen? Yes, the dot-com bubble was created through the internet boom and also through the adoption of mobile phones. And we're using both heavily today, but still, because we anticipated too quick growth in the year 2000, we first had to see how the market goes through a cleansing cycle. Will we see something similar for AI? Potentially. And so now when we have to make the decision for the risk on part of the portfolio, should we rather overweight tech stocks or should we overweight Bitcoin? Tech stocks are expensive, but unfortunately, so is Bitcoin. Because here's Bitcoin with the average cost basis of the market, the realized price. And I believe this is one of the strongest indicators for the Bitcoin macro cycles. Because when the current price is below the realized price, it's a very good time to buy. When it's above, we can ride the bull market for a while. But especially the times when we are below the realized price is when we want to be over allocated to Bitcoin. Now, why is the average cost basis of the market so important? It's important because everybody wants to have a somewhat balanced portfolio, right? When you put a lot of your wealth, say 10 or 20% of your money into Bitcoin, and then Bitcoin does a 5x or a 10x, suddenly, relative to the rest of your wealth, your allocation to Bitcoin is very large. And you might not feel that comfortable holding that much Bitcoin relative to the rest, right? Because initially you just started out with 10 or 20%. And so it's only natural when you're buying significantly at 20K that you are taking some of that profit at 100K. And so that's why the realized price is so important. Everybody uses the purchase price as an anchor point for how much did I actually buy Bitcoin and where's the current price relatively speaking. If the current price is below your purchase price, you're probably going to continue to hold Bitcoin if you don't have to sell it and if you long-term believe in BTC. So when the current price is below the realized price, the selling pressure tends to decline. When the current price is above the realized price, people tend to take some profit. And unfortunately, the market in aggregate is a lot in profit. It's more than 2x in profit. So on average, people bought Bitcoin for $41,000. So in the worst case, Bitcoin could go down 50%, maybe even more. But so could technology stocks, right? Who knows? It's not necessarily the best time to buy risk on assets. That's what I'm taking from this. For Bitcoin, there's even a more depressing number, and that's the long-term holder realized price. So we don't look at the average cost basis of the entire market. We just look at the average cost basis of the long-term holders. And this is, again, a very long-term chart. And again, during the bear markets, we tended to get very, very close to that long-term holder realized price. And the reason why this is depressing is because that average cost basis is only at $24,000. Now, I'm not saying that we're going to hit $24,000 tomorrow, but maybe the long-term holder realized price will climb a little bit more until we hit that price. Maybe we're going to see 30K, 35K, 40K. That's definitely on the cards. Now, here's the problem. Here is why most people get wrecked during times like this when everything is going down. The issue is most people only have a strategy for rising prices. When there's a bull market, the strategy tends to be, I'm just buying the trending altcoin and trying to make as much money from those rising trending altcoins as possible. But then the issue is, what happens when things turn around? What's really the strategy if we enter into a bear market? The problem is most people don't have a strategy and they simply just cling onto their altcoins, getting wrecked in the process. There's no real objectivity in the process. It's really important to have some kind of a plan, what to do and where to deploy the capital if things are not bullish, because there are ways to make money in bear markets. When Bitcoin is expensive, when stocks are expensive, when everything is expensive, there's, for example, the option to buy gold, right? After the dot-com bubble, gold outperformed regular stocks by almost 800%. So this is a gold relative to the S&P 500 chart. This is actually not what we associate with gold, right? With gold, we associate very low volatility, a very boring investment to just park the money to potentially protect against inflation. But it's not necessarily seen as an asset that can outperform during a bear market. But obviously, this relative valuation does matter. It's quite a bit of a move. And so if you're not too much invested emotionally, then you can potentially, when times are right, move into assets like this. Now, this is a very uncommon chart, right? Most people have never looked at gold relative to stocks. People just look at US dollar charts, and this is the problem. It's knowledge like this that I believe can give us a real market edge, because the US dollar is obviously devaluing over time, so everything tends to go up over time. But again, it's all about opportunity cost. And so have a look at this. This is a technical analysis course, and over here is one of the videos plotting relative valuation charts. In total, there are 26 videos in this course. And relative valuation charts are useful in all kinds of contexts, right? It's useful to compare gold to the S&P 500. It's also useful to compare an altcoin relative to Bitcoin. It's also useful to compare, say, an asset relative to the money supply to see, does this asset long-term actually outperform monetary expansion? But then there are also other strategies, right? Because most altcoins underperform Bitcoin most of the time. I believe that the bear markets are actually better opportunities to make money than bull markets. In bull markets, we have to find the precise few altcoins that concentrate all of the gains, and we have to exit quickly enough. In bear markets, actually in general, but especially in bear markets, most altcoins do worse than Bitcoin anyways. So we can simply bet on relative valuations going down. We can bet on an altcoin to do worse than Bitcoin. We are not betting on the US dollar price going down. We're just betting on the altcoin doing worse compared to Bitcoin. So for example, this is a position I had open for a long time. This is Balancer, so the Balancer token, that's a DeFi project relative to Bitcoin. And this underperformed very constantly under low volatility, by now 98%. And that's, I believe, a very nice approach, right? Why does Balancer underperform that constantly? It's again what we see time and time again, right? It's token allocations to the insiders and to the team and to venture capitalists and maybe to users of the platform. So supply is growing and growing and growing. The demand isn't growing as quickly, and thus we see that underperformance. Now it's important that this is relative valuations, that this is not just US dollar valuations, because the US dollar valuation of an altcoin, even during a bear market when we see a temporary rally, can of course go up, right? When Bitcoin goes up by 30%, then temporarily an altcoin can also go up by 20%, even if the supply expands. That's why the relative valuation makes so much sense. Because check this out, this is now Balancer relative to Bitcoin since 2023, and here is Balancer in US dollars since 2023. This is much more risky, right? This can go up by 100% if you time this not the right way. So I'm not saying that most altcoins go down all the time. I'm saying that most altcoins underperform Bitcoin most of the time. And so shorting altcoins is a pretty nice way to make money during a bear market as well. So we don't have to cling on that strategy to always buy the meme coins, and then when the market turns around we keep on holding because we hope just that it continues a bit further. We can be objective about it because we also know a strategy to make money during bearish times. And so here's one of the explainer tutorials gaining from relative valuations, how to short Balancer and potentially long other assets at the same time. This is one of, I believe, 5 different videos on shorting. How can we select an asset that's worth shorting? What kind of parameters do we have to look at? How can we also then set up that short, right? What are the technical requirements? What platforms should we use? And all of that is part of the premium membership of this channel. There's more than 100 tutorial videos in total. Feel free to check it out. Of course, I'm also sharing my own trades in premium. So I've just closed my short of Ethereum relative to Bitcoin. I made some money with that as well. And when times turn bullish again, then of course it does also make sense to buy individual alts again. That's why we've got the individual chats on various altcoins as well. But again, right now it might make in some ways more sense to learn about strategies that are not that common, that can make us money while most other people don't make money. So feel free to check it out. It's currently $165 per month. There's also a 1-week money back guarantee. So in case you don't like premium, in case you don't learn anything, just message me within the first 7 days and I'll refund you 100%. There's really zero risk for you. If it's the first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.